fire, storms, and shipwrecks, or other causalities of thief and embezzlement. Thus, if it may be occur from the loss of sales or other fixed asset. There must be reported or should be submitted a declaration of loss within 45 days from the date of loss in order to deduction of compensation by insurance or any form of indemnity.
In a total loss, the initial loss is the book value of the asset. First, I will define what is total loss. Total loss or write-off is a judgment by an insurer that the loss value or repair cost of damaged property exceeds the value of its policy, resulting in its concludes is a total loss or constructive total loss. In a total loss, the initial loss is the book value of the asset. For instance, the warehouse owned by Mr. Z has a total loss of 3,000 million pesos. It was destroyed by the fire. The cost of merchandise in the warehouse was 1 million pesos. The initial loss of the warehouse is 2 million pesos. Therefore, the book value of asset is 2 million pesos.
In case of partial loss of property used in the business, the measure of deduction from gross income is the book of value of the asset of the cost, to whichever loser reduced by insurance, recovery, or any form of indemnity. For example, they have a grocery the value of 100,000. They can destroy part caused by electric short circuit. Then the cost of destroy is the 60,000. Then the coverage insurance of the equipment is 50,000. So that the deductible loss would be computed. The formula is cost to restore the property is 60,000. The grocery value of the property is 100,000. Then whichever value is loser is 60,000. Then you can less the insurance recovery 50,000 and the deductible is loss because 60,000 is the lower and the insurance recovery is 50,000, so that the deductible loss is 10,000.
Deduction must be claimed in the year that the loss took place. The deduction must be claimed in the year that the loss took place. However, if the loss is covered by insurance, the recognition of the loss may be postponed to the year that the extent of the loss is finally determined with the receipt of the insurance proceeds.
Operating loss carried over. The net operating loss carried over the business in 1 year may be covered over the next succeeding 3 years and deducted from the gross income such a year in years to which is carried over. The net operating loss exists for a lower deduction over gross income. Example, in 2006, gross income is 500,000. Less deduction 900,000, the net loss is 400,000. In 2007, the gross income 600,000, less deduction is 500,000. In 2008, gross income of 700,000, less deduction in 2009, the gross income is 500,000. Less the deduction is 450,000. The net income before the no-cost is 350,000. In 2010, the gross income is 800,000. less the deduction is 450,000. The net income before the NOLCO is 350,000. The net NOLCO from 2010 in 2007 is 100,000. In 2008 is 500,000. 50,000 rather. In 2009, 80,000. In 2010 is done. So total is 350,000. The net operating loss of the year in 2006 conducted that be carried over beyond 2009.
Non-operating expense. But first, I would like to differentiate the operating expense and non-operating expense. In business, operating expense is a day-to-day expense such as sales, administrations, and research and development, as opposed to production, costs, and pricing. While non-operating expense is not directly related to the operation of the company, incurred by activities not relating to the core operation of the business, it is relating to the employee's benefits, pensions, and contributions. Therefore, the effect of non-operating expense in the interest expense in business is that there's no effect because operating expense and non-operating expense is taxable. In terms of interest expense, it covers the amount reported by company or individual as any expense on borrowed company.
Settings on deduction for losses. There are two losses, which are deduction, for either of which has selling there are, and the rules for them are: A. Capital losses, which are deductible unto the extent of capital gains. Capital losses are used first to offset capital gains, or if the capital losses are larger than the capital gains. You can deduct the capital loss against your other income up to a limit of $3,000 in 1 year. If your overall capital loss is more than $3,000, the excess carries over to the next year. In other words, you treat the extra portion as if it were an additional capital loss in the following year. A capital loss is essentially the differences between the purchase price at which the asset is sold, where the sale price or lower than is the purchase price. For example, if an investor bought a house for $250,000 and sold a house 5 years later for $200,000, and the investor would realize a capital loss of $50,000.
The other deduction for losses. Wagering losses, which are deductible only to the extent of wagering gains. Losses as the result of gambling or wagering are generally deductible because gambling is an activity to produce income. The legality or illegality of the gambling doesn't impact the deductibility of your wagering losses. When you win, you have income that you have to report in your tax return. Of course, more income generally means more income taxes you have to pay for the year. If you lose, you can take a tax deduction. This deduction can help offset some of the additional taxes you owe in the winnings. However, there are certain restrictions on the tax deduction. The amount you can deduct is limited. In addition, you have to be able to prove the amount of your deduction. Wagering gains and losses are arising from wagering transactions. These transactions, where the outcome depends upon the chance. The traditional example of wagering loss is loss from gambling.
This This is a Cinema Production.